His income goes into a cheque or savings account, and then once a week or fortnight or month, a repayment's going to be coming out, going towards the home loan. They're very, very basic, and obviously the banks like clients on these because they're the most profitable for them. The next style loan is called a line of credit or an equity line. These were brought out to Australia by Citibank 15 or so years ago, thought to be the best thing since sliced bread. On paper, got clients out of debt in 7 years. On paper. Sounded all well and good in theory, but the reality is that once clients got into these line of credits, they're just like one big credit card. They put all their money into their home loan, they take out all their money out of the same account, they actually have no idea how much they've spent each week or fortnight or month until they get their statement at the end of each and every month, and they've actually spent more than what they've earned. They've put in $5,000, they took out $7,000. They've chewed up the equity in their house, they end up at their limit, and then all of a sudden, in a state of despair, refinance back to another 30-year principal interest loan. Very dangerous unless you're a great budgeter. Only 2% of Australians are great budgeters, and they're not very much fun at parties, so we'll stay away from them. Offset accounts. These are, from the bank's perspective, the principal interest loans based over 30 years, but with a bit of a tweak. So how they work is all your income goes into an offset account. Whatever sits in that offset account offsets against the mortgage. So if you've got $5,000 sitting in your offset account, your mortgage at $300,000, you're going to be paying interest on $295,000. The reality is that most Australians don't have the self-discipline to be able to keep a substantial amount of money in their offset account. Because they've got access to it, they'll usually spend it. And the other downside is we've done studies, Canex have come back and said the actual amount you need in your offset account at all times for that loan structure to be more beneficial to you than the top loan structure, that 30-year principal interest loan, is $12,000. So how many Australians do you know that have got more than $12,000 sitting in their offset account at all times? If they don't have $12,000 sitting in their offset account, it's actually better for the client to be back onto one of those original 30-year principal interest loans. Now the fourth style loan is the newest loan on the market. That's called a premium product, and how that basically works is all the client's income goes into their home loan, and in their home loan, the amount that hits that home loan stays off their debt. So once again, if they have $5,000 in income hitting that home loan account, their debt goes from $300,000 down to $295,000. And then what we do for the client is we go through their spending plan. We work out exactly what the client needs to live off. We then transfer their living expenses into their cheque or savings account of their choice on a weekly basis. So anything that they need for food, bills, fuel or entertainment, we transfer that for the client from their home loan account into their cheque or savings account of their choice. We do that on a weekly basis, and it's to cover expenses that you pay weekly, fortnightly or monthly. The rest of their income we keep in their home loan account working for them, out of sight, out of mind. They can't go to the ATM and take money out of that home loan account. They've got to come back through us, and we then manage that home loan account on the client's behalf. So what we can guarantee, we know exactly how much money hits their home loan account, we know exactly how much money we transfer back out of their home loan account for living expenses, and we guarantee they're always going to have more coming in than what they have going out. We also hold back all their money for their large annual expenses. So if they've got money for rates, birthdays, holidays, Christmas, car rego, anything the client's got to pay half yearly or annually, we hold off those expenses. We keep that money locked in their home loan account for the whole year. If and when they're ready for their rates, they call the office, and within 24 hours, the $2,000 for the rates is in their cheque or savings account, and they go pay their rates. So it's basically a line of credit on steroids. Probably the easiest way to explain it, with all the benefits of the line of credit, getting the income working for you, without the downside of the self-discipline and the accountability which is built into the product. So from there, we then ask which, out of those 4 loans, client, which would you like to hear more information about today? The client, 9 out of 10 times, will hear that, will select that 4th loan product. And from there, we then get into obviously the loan structure and how it works in a lot more detail further on in the appointment. Now, the spending plan. It's very, very important that you touch on this very quickly for the client. They'll see this, and obviously flashbacks of having to do a budget and everything like that will come through their mind. Certainly not the case. It's pure and simply a tool which we get them to fill out over the next week or so for us to be able to work out a rough amount which we think is going to be ideal for them to have transferred from their home loan account to their living account on a weekly basis. something you just want to touch on. Don't do it in front of the client. Don't let the client do it in front of you. It'll just take 20 to 30 minutes. They need to do it in their own time, and it needs to be done before settlement. So there's no hurry on that, but once again, it just gives us a really good indication as to how much the client will require for a living expense to be transferred from their home loan account to their cheque or savings account on that weekly basis. This last page here is the application checklist. Just gives you a really quick checklist on what documents are required for us to get the loan approved, and obviously we'll be leaving this with the client if we can't get all the documentation at the point of signing the application. Now this is a dare to compare worksheet. We've just added this. It's quite impressive. What it does is it sets all the banks against each other. It goes through all the services and benefits they'll receive from that fourth loan product, which is obviously the Crown Money Management program. And from there, what you're going to find is these clients are going to compare their existing structure with CBA or Westpac or whoever it may be with what we can do for them. And as I said, really good instruction for them to dare and compare their current loan. And obviously, it's going to come up well short of all the benefits that we're able to generate for the client.